let me start with just talking a little bit about the CDFI sector in the U.S. And if you can't hear me, if I'm dropping the mic, somebody just raise your hands in the back and I'll lift it back up. There are, by various counts, probably about 700 or 800 CDFIs operating in the United States today. They come in many forms. That includes community development credit unions and community development banks. I should note that community development credit unions are not the same as all credit unions. There's a difference, which we could talk about if you want to. And community development banks are not the same as community banks in the United States. So another distinction. And then there are community development loan funds and community development venture funds or equity funds. Very few of those in the United States. I would say, this is a very rough number, I would say about half of that 700 or 800 CDFI, that total of CDFIs, are what I would call sort of well-functioning CDFIs that are doing a lot, that are active. Others are doing something. They may be doing things beyond financing, and that may be a harsh number, but it's important to sort of recognize that. And they are primarily in the business, all of them are primarily in the business of providing credit. The CDFI industry in 2011 provided about, I think, about $4.5 billion of credit in the U.S. So, to give you some idea, cumulatively, as far as we can tell, they've provided about, all the CDFIs in the U.S. have provided about $40 billion of credit in direct lending. That money is going primarily, first and foremost, for housing, and within housing, for multifamily housing, for apartments or other forms of multifamily. Increasingly, there's been some activity around single-family mortgage lending and home fix-up, home rehab lending, particularly with an emphasis around green, about energy efficiency fix-up of homes. But it's also gone to businesses, small businesses, micro businesses, mid-sized businesses in some cases, and also nonprofit businesses, which have been a significant part of CDFI lending. And just for a point I'm going to make later, I would just group both the for-profit and the nonprofit businesses. We've started to calling them together as community businesses, as a way that sort of reflects what's going on in the communities, where they play equal roles sometimes as employers or in providing products and services. So I'll come back to that term in a minute. And there's an emerging role in the U.S. for CDFIs in the provision of consumer products and services. It's an important area that CDFIs are being challenged to step into in some ways. So that's definitely part of our future. About Opportunity Finance Network, we're a national network of community development financial institutions. Of the, however many you want to count them, 800 CDFIs, there are about 200 that are in our membership. Those 200 tend to be, by self-selection, tend to be higher performing CDFIs and tend to be committed to performance. And so most of that financing that gets done on an annual basis is done out of the CDFIs that are in our membership. I can talk a little more about our membership structure, but we are for lack of a better term, a selective, but you might say an exclusive membership. Not anybody can join. About one of every two CDFIs that apply for membership in OFN are admitted as members. The others we try to support and help and provide other services to. We do a few things. We have a convening role. We have a big annual conference each fall. That's where the industry comes together, both the investors as well as policymakers and CDFIs. And I'll invite all of you to join us in October in Philadelphia. We do other kinds of convenings and bring CDFIs together for a whole range of conversations. We have a consulting line of business that is a fee-based consulting business that provides services to investors, to CDFIs, and to third parties. So one of the big things going on in the United States in the CDFI space is that the federal CDFI fund, which is our program, is a program in the Department of the Treasury that's focused on our industry, is running a large capacity building initiative where they choose a sector. So we did one on healthy foods, because one of the big issues in distressed communities in the U.S. is the lack of access to healthy foods. And we've done work on that. We're doing work on microcredit and some other things right now. Other things really quickly about CDFIs, and I can put this down, are about OFN, is that we do a lot of work and have focused very heavily on the two areas I'm going to talk about: communications, messaging, marketing, brand for the industry. And as we deal with being increasingly public in the U.S., both in the government sector and the private sector, and policy, and I'll talk a little bit about that. So, in 2005, and I forget who I was talking to earlier, but someone was there for this discussion. We did some market research about the brand of CDFIs, and what we found was shocking to us. And I don't want to suggest this is true in this country as well, But what we found was that the term community development in the universe, in community development in the United States, was disliked harshly by essentially 100% of the people we talked to. So our mothers didn't like CDFIs, right? And they didn't like the notion of community development. And there were terms that came up again and again. The terms were that it was government-driven, that it was broken, that it was often corrupt, but at the end of the day, it just didn't work. That was what people think of as community development in the United States. Now, Dan and I don't think that, right? But just about everybody else did. And in fact, a lot of people in our industry thought that as well. And so, in particular, part of that research was we did a focus group, and the focus group had about 20 people who were senior level corporate executives in Wall Street or in banking, and 20 people who were high net worth individuals who were qualified investors, which in the United States means, I think you have to have $3 million to be a qualified investor, or something like that. Well, how much? Some large number that most of us don't have. And we had this discussion, and part of that was we presented a description of what CDFIs do. And so we lend for affordable housing and nonprofits and small businesses in distressed markets, or whatever the language was. So first we gave them the description, and we said, what do you think? And they said, well, it sounds really interesting. Would you invest in it? I'd consider investing in it, which shocked us. We didn't expect that. And we said, well, what kind of yield would you want if you invested in this? It's a fixed income investment, what would you want? And the numbers they gave were roughly at the high end of what a fixed income market rate investment would return at that point. And that stunned us, because we never imagined that would be true. So we asked them that 2 days later, because they came together over several days, 2 days later we asked them we gave them the same description, except we added the language, including community development, and said, what do you think? And they said, not comfortable with that. Well, why not? Because it's community development. Well, what's wrong with community development? Same language. And we said, well, would you invest in that? Probably not. I might, I'm a wealthy person, I might donate some money, but I wouldn't invest in that. And we said, well, we pushed them, and we said, if you would invest in it, what kind of yield would you expect? And the numbers, although they were a little all over the place, were roughly 600 basis points above what they had said 2 days before. And we came to realize that we had a really significant problem that was characterized by that 600 basis point differential. We were paying a premium in one way or another for the way we described ourselves and the way we related externally to the world around us. And so that set off a rebranding of Opportunity Finance Network. We used to have a different name. And more importantly, it set off a whole effort that's still ongoing to describe ourselves differently to our friends, as well as to the people we don't know yet. So to policymakers, to bankers, to the general public increasingly. And it's caused us to really change the way we think about ourselves and the way we get CDFIs to think about themselves. And there are a few things about that. In that same focus group, after they told us they didn't want to invest in us, we said, well, but you said you liked us. What do you like about us? And they said, because you finance opportunity to a person. You finance opportunity. And we realized after some market testing that word opportunity and the idea of tying money to opportunity, at least in our country, was a really powerful idea, and hence we became Opportunity Finance Network as a result of that. So we pushed that a lot. We've done a lot of things and a lot of training with our members to try and bring that along. Two things have really changed that, one more than the other. First was we developed, we decided we wanted to have a communication tool that could reach a mass audience. And so we developed a video. It's called Opportunity Multiplied. You can see it on our website if you decide you want to go there and look at it. It's a 3-minute video to describe CDFIs. And it was completely different than anything we'd ever done before. And it's been largely successful. We gave CDFIs a tool to explain what they're doing, so now their moms understand what they do, and it's been a really effective tool. Second thing happened that was coincident with, that happened during the recession really, which was that there's a little company, a little bigger in our country than here, called Starbucks, that had this idea, Howard Schultz, who's the chairman there, had this idea that corporate America should be doing more to help with the jobs crisis in the United States. And so in August of 2011, he started off by writing a letter to America, which he published in all the papers, that said a number of things, but among the things it said was that American corporations need to put their cash to work where they're, in their communities to help deal with the jobs crisis. And he threatened his CFO with the idea that Starbucks was going to become a direct lender to small businesses in all the communities where they work. They have 7,000 stores in the United States. So 7,000 places they were going to become a direct lender unless they could come up with a better idea. And the CFO rightly said, that's the last thing we want to do, so we better come up with an idea. And they reached out to us because we had a bit of a relationship with them, and very quickly formed something called Create Jobs for USA, which is an effort to raise money both from corporations and from individuals to support CDFI lending for community businesses. That's where it came into play. And I won't go through all the details of it, but Starbucks is pretty good at marketing, like as good as just about anybody at marketing. And so they brought the full force of their branding and their marketing and their communications team behind this effort, and we brought to them a distribution network, a way of when they raised money, getting it out to CDFIs on a performance basis, because we had to know that if someone, if Nick, as he just did, gave us $5, gave us $10 actually, thank you, but he gave us $5 to support job creation. We wanted to know that it was really going to get something done. And so we had to have a sort of performance element to it. And part of the element of this, and I brought these along, is that you can go into any Starbucks store and buy a wristband. It's not called a bracelet because marketing told us that teenage boys don't wear bracelets, but they wear wristbands. These are for anybody who wants to take them, and if you want one, you don't get one, give me a card because we have 18,000 more of them in the office. So, but we distributed more than 800,000 of those at $5 a pop, mainly through Starbucks stores, through 7,000 stores. More important, from a CDFI brand perspective, we generated, within the first month of this campaign, the campaign generated over 1 billion media impressions, which means that many billions of people had heard of us and thought of us. But it also changed the way we talked about ourselves. Starbucks taught us that in order to connect with someone who never heard of a CDFI before, who frankly didn't care and doesn't care what a CDFI is, and doesn't even particularly care about the fact that we're benefiting low-income, low-wealth people and communities, that we had to talk to them in a different way. And so it changed our vocabulary dramatically in how we presented this. And it was probably the most nerve-wracking thing I've done in years, was sort of signing off on how we did that. That was really important and taught us a lot, which I'll say a word about in a minute. But it also rebranded the entire CDFI industry in the United States, because suddenly we weren't CDFIs, we weren't financial institutions, we weren't community development, we were a solution. And that's the word that we learned that came out of this. We are a solution. And that's how people that know of us, believe about us, and that's what people respond to. We've learned to tell that story. And so sort of the next phase of that is really to figure out, and we're working very hard at this now, how to build a brand that reaches a mass market, that builds on what we've done there, that builds on two things. One, the fact that we are solutions, and two, the stories that we're telling are not about CDFIs, they're not about the banks or other folks who invest in us, they're about the people who are benefiting from and making great successes out of the access they get to our financing. And so that's one part. I just wanted to comment about that. Really quickly about policy. I probably have used up my time, right? I'll go really quickly, I promise. We talked a little about the Community Reinvestment Act, which was passed in the late 1970s. Community Reinvestment Act is a necessary but not sufficient tool of policy. It's necessary because it makes it the law of the land that financial institutions, that banks, actually not all financial institutions, that do business in communities have to do business with all the folks in their communities. It's a very important law, from not just for CDFIs but for all of our partners. But it is not sufficient. It is outdated. It has some challenges. It's not going to change in its own way, but it is really important. And there are ways we may want to talk about that I think we could move forward with better sort of laws building on CRA. We also have in the U.S. the thing called the CDFI fund. CDFI fund is important for two reasons. First is simply that it's been a source of net worth or equity capital for CDFIs in the United States that have allowed us to do two things: to borrow more. It made us much more appealing to investors because we had more protection for them. And the second thing was, through the recession, it gave us a cushion. It made sure we had a cushion, and that most CDFIs had a cushion to not only absorb the losses that were going to happen, although there weren't that many losses, but to absorb them, but to think differently about the problems. When you have an equity cushion, you can decide that you're going to be more aggressive about how you deal with these problems, and that's really important. There are other things we can talk about. There's low-income housing tax credit that's been critically important in our country. New market tax credit, which I know was a model for some of the tax thinking that the Social Investment Task Force did. We recently, a few years ago, passed a program called the CDFI Bond Guarantee Program, which was a breakthrough program that's supposed to provide $1 billion a year in long-term, up to 30-year, low-cost capital to CDFIs. It was really a breakthrough in potential. We've had a lot of problem because our Treasury Department, which is charged with implementing it, has taken as much time as they can and is still taking more time to implement it. So it's a funny situation that this administration's Treasury Department has actually slowed us down on some things. So, and the last thing I would say about policy is that because of the way we performed and the role we played through the recession, we continued to lend as aggressively as we could. When there were a lot of folks out there saying there are no deals to do, we were able to say, yes, there are, and we're doing them, and it can work. That we went through the recession, and we had a blip. I remember a conversation I had with Dan Letendre, who's going to speak in a minute, in late 2008, when we talked about whether 2009 was going to be the year when the industry just imploded. Because it seemed entirely plausible to us that we would not make it through even the first year of what happened. In fact, CDFIs were able to manage that risk and came through much stronger than they went into this. We have historically net charge-offs of about 1.7% in our industry. They went up a little bit during the recession, but not a lot. And that performance alone has changed the way a lot of partners think about us, and it's certainly changed the way the role we played and the visibility we got out of the role we played has changed the way that government and investors view CDFIs in this country. I promise I'll end now. You're kind to me to not knock me down here, but really quickly, keys to our success. First is humility. We understand that we are a small part of a solution and that we need to work with as many others, and that there are sort of no permanent friends and permanent enemies. If we can get things done with people who have disagreed with us in the past, we need to be able to do that, and CDFIs have been very agile that way. Discipline and performance. We take performance very, very seriously in the United States, and that 1.7% figure that I mentioned is probably the most important figure that we have, because we've done $40 billion of financing with good results. Third is, I think that it's really important to sort of be able to look at our markets and our performance and our CDFIs with brutal honesty. I said earlier that we're a membership organization that rejects 1 out of every 2 organizations that applies. Doesn't make us popular, but we have a responsibility to ensure that the performance going forward is as good, if not better, than what it's been in the past, and so we do that. And the last 2 things, really quickly, are that, that we have what my predecessor in this job used to call institutional ego. And by institutional ego, we mean that we have to believe that other people should think the work we do is as important as we think it is, right? And so you have to have that in order to be successful in this business. And the last thing that I promised someone I was going to talk about was you need to be able to tell your story. The data are really important, necessary but not sufficient. People's opinions change and you influence people by the stories you tell. You need data to do it, but you need to be able to tell the stories of your borrowers. You need to be able to tell the stories of your successes. You need to be able to tell the stories of your failures. And that's a critical part of what we do. And so I will end, but the last thing I'll end, Ed, I think earlier you talked about this business is walking on a tightrope, and I think that's right, and I think it has been in our country. But my personal favorite rabbi is a rabbi who died a long time ago, and one of the things he said was that all the world's a narrow bridge, and the important thing is not to be afraid. So thank you.
My name is Dan Letendre. I'm at Bank of America Merrill Lynch, where I manage a team that focuses on CDFIs and exclusively CDFIs. First, I want to thank you so much for inviting me to attend. This is a wonderful opportunity for me, particularly to look, listen, and learn. I'm located in New York, which means my wife, my family, and my business is 5,000 kilometers away. But after spending the morning focused on community investing and the challenges of CDFIs, I feel very much at home. For the past 18, 19 years, I focus exclusively on building a business focused on financing CDFIs. So I manage a team of 12 individuals who just finance CDFIs. Our clients list at the end of 2012, we have loans or investments in 240 CDFIs, operating in every one of the 50 US states and the 75 largest cities, municipalities, and towns in the US. The portfolio at year end was equivalent to a little over 700 million pounds. And it's one of the strongest portfolios from a credit perspective in Bank of America Merrill Lynch. It's been a very successful business for us on a financial basis as well as an impact basis. I'll keep my comments somewhat short because I'd really like to engage in conversation. Again, for me, this is an opportunity to look, listen, and learn and share thoughts, but I will share really 3 observations that might not be straightforward or generally assumed in the CDFI business, particularly in the States. The first is that the Community Reinvestment Act no longer drives Bank of America's CDFI business or CDFI investing. Yes, it was a big encouragement at the start and really got us to focus on how do you end up lending to CDFIs to serve low and moderate income communities. Again, brief snapshot, the Community Reinvestment Act, or CRA, is essentially the law that says if you are a bank and you accept the government guarantee on your deposits, the quid pro quo for doing so is that you have to lend to low-income communities as well as upper-income communities. You're not required as a bank to serve poor communities. You can opt out of the deposit insurance. No one's ever done that, but that's the quid pro quo. That originally was a strong motivator and got us thinking, so how do you end up financing directly or indirectly in low and moderate income communities? And CDFIs are a strong avenue for doing so. But today, I'm convinced CDFIs are among the most innovative, creative, flexible, and responsive financial institutions anywhere. They have become partners of ours in a whole variety of areas, which we'll talk about, that Bank of America invests in for our own self-interest to help us solve problems that we wouldn't be able to solve without CDFIs. CDFIs were the first ones to figure out how to effectively lend to charter schools in the United States, to effectively lend to private primary health care facilities serving low-income communities, to finance and provide capital to open child care centers, and have come up with some of the most innovative, creative, and safe and strong performing home mortgage products. There's a whole variety of areas CDFIs have actually been a tool of innovation for financial products. Second, I would say that a minority, maybe 20%, maybe a little less, of our CDFI clients are at or above a level that would be described here as self-sustaining. Maybe 20% at best of our clients, and our clients are among the most financially strongest within the industry, maybe 20% are self-sustaining by what I will describe as the gold standard, which would simply be that the interest earned and the fees earned on the loan program covers operations, covers interest expense, and cover loan losses. Break even or better on that measure on a gold standard. I would say about 80% or better of our CDFI clients meet an alternative view of sustainability, which recognizes the fact that the challenge CDFIs have is not the repayment of the loan portfolio. Because as Mark said, the repayment of the loan portfolio charge-off rates are less than 2% on a system-wide basis. The challenge is that the cost to generate those loans that perform that well in low and moderate income communities can't be covered by the interest earned and the fee income earned on generating those loans. It's the operating expenses, it's not the loan portfolio. So when we think about sustainability, I use a slightly different alternative, which is that the loan portfolio, as it pays off, is more than sufficient comfortably to cover any debt payments that the CDFI has because they borrowed money to lend it out. That the repayment of the loan portfolio is self-liquidating. And second, that the CDFI has been able to, over a period of years, demonstrate that year in, year out, it is able to fundraise, whether it is philanthropic grants, government contracts that may be long-term or short-term that get repeated, or fundraising, or its own internally earned cash to cover its operations year in, year out. If you can demonstrate that, if the CDFI client can demonstrate that over time, and has a loan portfolio that would liquidate and pay us off, that to us is self-sustaining. That's a very different model. Because if I think about the kind of the gold standard for banks in performance, it might be 100 basis points ROA, which would probably have been in the old model about 12% return on equity. That was always the, for community and small and mid-sized banks, 100 basis points ROA is kind of like, if you hit that through a cycle, you're doing really, really well. Sustainability, if you view it as the standard, the original standard, which is that you cover all of your operations, would be better than 0% ROA. And so if you give the banks the market on anything that you can earn a 1% ROA or better, and CDFIs are required to cover 0% or better in ROA, that's a relatively small area from that perspective that CDFIs can participate in. That's not the sector of where all loans that can be made and can be repaid, which is a different model. So for us, relatively few CDFIs fit in that range of 0% ROA to 1% ROA. The vast majority of CDFIs, however, can demonstrate that their loan portfolio is sufficient quality to repay the debt was borrowed to the origination, and that year in, year out can sustain their operations one way or another. Third, say that while the CDFIs we work with certainly operate on that margin just outside where mainstream banks perform. We've had a debate over years about whether or not the role of CDFIs kind of start at the mainstream and try to work in as far as you can, or whether or not you start at the poorest of the poor and come back this way. Well, most CDFIs, particularly those that are our clients, start at where the mainstream banks leave off and then try to serve as deeply as they can on what I would describe as a sustainable basis. But that market is not a constant market. Literally every month, and certainly through the business cycle, that spot where banks leave off is continually changing. And our CDFI clients continually change with where the bank market leaves off. And so our relationship with CDFIs, to a very large extent, when you have 240 CDFIs operating in every one of the 50 states, is used as an extension of where Bank of America would leave off at any moment in time. And that is a rapidly changing, throughout a business cycle, place. And so it's not, when I first started, it was essentially provide capital, throw it over the wall to the CDFI in a market that we didn't understand. Have the CDFI lend out, and when they got their capital back, they'd throw it back over to us on this side, and that would be an effective model. They would serve a market we didn't know about, and they would pass capital back to us with a discipline and a set of priorities that they didn't know what was driving us. CDFIs really, for us at this point, is an extension and are able of where we leave off and are able to do things that we might like to do, but for a variety of reasons can't. So 2 examples. The first time that really was driven home for me was in the days immediately after September 11th. I live in New York, downtown, September 11, 2001, Tower City. Lower Manhattan completely closed down for about 3 months. A lot of small businesses served the area, completely out of business, no revenue for a long period of time. And we all started thinking about, so how do you sustain these small businesses on a going forward basis? How do you let them start back up again? And so we started thinking, need a loan program. Need a loan program so that they can pay their bills, reacquire inventory, get started. And we looked and said it's probably a loss rate of 20, 25%, something like that. And looked and thought, well, clearly we're not going to make loans where the expected loss rate going in is going to be 20%. The banks are not going to make the notes. And so we understood that public sector said, yes, we'll end up having to provide a subsidy source, a first loss, so that this higher level of risk. No one's going to give Bank of America the grant, not in 2001 and certainly not today, to make loans that have perceived level of risk that's higher, etc. But they were absolutely prepared to provide that first loss to a nonprofit, mission-driven organization that had credibility in that mission. We would provide the capital, a public sector or philanthropic source would provide first loss, and CDFI served as a vehicle to make loans that our small business bankers would simply run from. You run from a loss rate of 25%. Loss rate wasn't 25%, closer to 12%. Very successful as an economic development engine, stabilizing an area. The devastation would have been far worse if we didn't do that. Last month, hurricane in New York occurs the days immediately after. I'm calling our 12 CDFIs that we have in the New York metropolitan area that we have capital out to ask, so what kind of loans and what kind of financing need that are out there? And it was small businesses that needed to rebuy inventory because it was flooded or spoiled because of loss of energy, electricity for 2 weeks, and homeowners who were flooded, walls with mildew needed to be knocked down quickly, inner walls, and rebuilt to prevent the spread of mold. CDFIs were able to make quick loans that bridged the probable repayment from insurance proceeds or governmental support. probable, not absolutely certainty, and those loans are absolutely getting repaid. The first thing we did is call the CDFIs, understood what they were able to do and act more quickly than what we would be able to launch a large loan program inside a national bank. Just examples of using CDFIs today for our self-interest. And so, big reason to come is at the end of last year, we took a look back at what we think is a very successful portfolio for us. We lend to CDFIs because it is in our self-interest to do so for some of the reasons I described previously, and I can go a lot longer. It's in Bank of America's self-interest to be financing CDFIs because CDFIs are solutions. One, but we have self-interests outside the US. There are CDFIs outside the US, and there are areas of underprivileged, economic underserved areas, and poverty outside the US. So why would we stop our CDFI portfolio at the boundaries of the US? Our conclusion was, doesn't make sense for us. Now, we're not going to earn a single piece of CRA credit operating outside the US. It's irrelevant. But the CDFI portfolio in Bank of America is not really driven by CRA, about our self-interest and about using CDFIs as a solution for problems that we might see. So I really want to thank you for the opportunity for me to look, listen, and learn. It's been a big help. Thank you.
First of all, I wanted to clarify, first of all, big society's role in providing finance to CDFAs and what sort of CDFIs we can and cannot provide finance for. And then I wanted to make some comments and try to link into some of what Mark and Dan have said on the policy context here in the UK, and particularly as it relates to CRA and CDFIs. So in the first point, big society capital, the capital that we have, the dormant accounts, are directed to us through the Dormant Accounts Act that was passed in 2008. That Dormant Accounts Act allows for the creation of a social investment wholesaler, which is us. The role of that social investment wholesaler is to provide funding to what are defined as what are called social investment intermediaries. Social investment intermediaries are defined as organizations in the Act that provide or facilitate the support of funding, provide funding or facilitate the provision of funding to third sector organizations. And third sector organizations are defined as organizations that exist wholly or mainly for social purpose. So what's important about that definition is, first of all, we, the wholesaler, must give money to intermediaries. Secondly, those intermediaries must give money to third sector organizations. And those third sector organizations obviously have to exist for social purpose. Now, the issue that we face when we deal with many members of the CDFI is twofold. First of all, that many CDFIs actually provide the vast bulk of their finance not to social organizations, but to small SMEs in deprived communities around the country. And I'll come back to why I think that's a very important activity. But we have to recognize that as the Act was written in 2008, big society capital is not allowed to provide funding to intermediaries that support SMEs, regardless of the size and regardless of where they're located. Neither is it possible for big society capital to provide funding directly to organizations that provide lending to individuals. So many of the number of CDFI members do personal lending. And again, this is not a comment on the value of that lending, but it's just a fact that as the Dormant Accounts Act was written, it's not something we can do. So what we're left with is we're left in a position where we can only directly finance those organizations that are lending to directly to social organizations. And there are a number of very fine organizations, CDFIs, that do that. And they are the ones that are eligible for finance. But what that leaves us, and now I'll sort of switch from a personal view, is we have the opportunity to support to provide funding to a whole lot of programs in this country that try, for example, to help young people improve their educational achievement, have a better chance of entering the workforce, and so on. And that's all very worthwhile, and that's all stuff that we want to do and will continue to do. But actually, particularly when you travel around this country, what we really need, most of all, is capital provided to entrepreneurs in deprived areas of this country so that they can create companies and create jobs. And the unfortunate position that we are in at Big Society Capital is that we can't directly do that. We can do it indirectly through support of various programs, but we can't do it directly. And speaking, as I say, personally, that's a very frustrating position to be in. And this issue of what we could call place-based investing, meaning let's get capital into places which really need capital and let's help create companies and jobs, is not something that we can do. It is something, obviously, that a large number of the members of the CDFA do, and that's why the work that you do is so important. And that's why we've lobbied government to suggest that there should be some way that we can address what I defined as place-based investing. But at the moment, we are where we are. We're bound by the rules of the Dormant Account Act. I wanted to clarify that, and again, stress the importance of getting capital into deprived areas and getting capital to communities that really need capital to help drive development. I think in terms of a policy perspective, you talked briefly about CRA, because it's come up obviously a lot. I suppose my credentials for being on this panel is I used to work for a very large American bank, JP Chase. And there's one thing of which I'm absolutely sure after that experience. CRA credit makes a difference to how these organizations lend. Now, it may well be the case, I think Mark has correctly and eloquently made the case, that CDFIs actually are a good business for these banks. But he also made the point that the reason they got into it initially was because it drove and produced CRA credit. And U.S. banks care very deeply about generating CRA credit, and I think they still do. And I think it's going to be very difficult for us to persuade our banks to broadly embrace CDFIs and community lending without having that sort of added incentive to do so. And all we're demanding, as Mark and Dan made this point, is all that CRA means is that you're being relatively transparent, at least to the regulators, about where your lending is going. And we the taxpayer, provide or pay for effectively deposit insurance, and we still, I think, pay for effectively underwrite organizations. The large banks in this country, and I think also the large banks in the United States, are still too big to fail. We may have moved from where we were in 2006, 2007 to a point where failure is a lot less likely and capital ratios are a lot higher, but we are still in a position where if a major bank in this country or a major bank in the United States were to face insolvency, we, the taxpayer, would be left holding the bill. So I think that gives us some rights in respect of certainly in respect of transparency and having a clearer perspective of where the assets of these organizations are actually being lent. So that's one point. I think the second point on CRA and CDFIs in the US too is it is important to remember that a very large percentage of what is done, of what is loaned, is actually real estate lending to affordable housing. So I think when you want to try and compare the broad CDFI community in the US to the UK, I do think you have to somehow factor in the housing associations into this. And remember that our banks do lend £60 billion to housing associations. And I think if you suggest that CRA covers, or you want to see a much bigger contribution or a much more greater focus on community lending, I think they will say with some justification that their lending to housing associations does actually represent a large part of what's being done in the US. I think our community development finance institutions are really held back significantly by the fact that by the restrictions on lending in the housing sector. And finally, I suppose the other point I'd make is, it is still the case that the lending that's being done by mainstream financial institutions to community development financial institutions is done on the basis that that money will be returned. And I mean, Mark and Dan and I had a very interesting discussion yesterday on this gold standard sustainability versus the silver standard of sustainability. the gold standards of sustainability, meaning your interest and your fees cover all your expenses and your funding and your operating expenses, your write-offs, and your funding, is still a very rare thing. It's very rare in this country. It's very rare, as Mark says, 20% in the United States. So that's going to be very rare. The other 80%, you're still going to need some equity capital. And equity capital in CDFIs comes from both in this country, I think in the United States, effectively from grants and donations. So we can't lose sight of the fact that we're still going to need to support our CDFIs. And I think the CDFI fund, which Mark mentioned, is there are potentially I guess that comes directly from the federal government, is that right? So maybe we can, we obviously have had some funding through various EU funds and so on, but it's important to remember that that's part of the equation too. You know, CRA opens up the tap, I think, to a greater extent for mainstream banks, but you also need that equity layer, that grant layer, and that's why you need something that looks like the CDFI fund. So I guess I'll just close by saying, you know, I do endorse the growth of CDFIs in this country and the growth of community lending in this country is critically important if we're going to address some of the important social issues, increasingly important social issues that exist in our community. It's not a free lunch. It will require some policy change. I think you'll see a much greater debate over the next couple of years as we come into the election, particularly about areas like CRA and whether or not we should do something equivalent here. But it also demands, I think, from the lenders. I mean, 1.7% write-off rates is, I will suggest, a significantly lower write-off rate than the sort of write-off rate we see here from CDFIs, and I think that illustrates the sort of credit disciplines that you need to get to in order to really access and grow to the sort of $40 billion or so that Mark referenced in the US. Thank you.
Question for Nick. I thought your remarks really about the need for equitable capital for CDFIs was really right on target, and also your points about transparency. And I understand your frustration because of legislation in terms of what you're able to do. Given that the work is underway in terms of the Small Business Development Bank and also the Green Investment Bank, might it be possible, because if you look at the spectrum of what those organizations, including your own, cover, and they cover most of the CDFI sector, might it be possible for some task force to work with the CDFA to develop a CDFI fund? And might it be possible also to look at the fact that at the moment, CDFIs are discriminated because the funding for lending scheme, which allows banks and building societies to get access to capital at rates that CDFIs would kill for, under 1%, couldn't that be opened up in some way to CDFIs? Because I think they haven't been thought of, perhaps, in the development of that financing mechanism, so that we could have a short-term and a longer-term solution.
Alison? No, both. Just with Alison there.
Oh, sorry, Alison.
Yeah, another question for Nick. I think
bit closer.
The presentations from the States were incredibly helpful, I think, hopefully to this UK audience, or mostly UK audience. Got the comment you were making about closer interest on CRA in the next 2 years, certainly as a coalition, that's one of the things we've clearly been focusing on, although we haven't actually specifically referred to that or explicitly referred to it, because we do feel quite strongly there should be a UK brand to that reflects our own environment. And it's really just a call to say we'd really like to work with you to help develop some of the narrative around that going forward, and ask if you're willing to do it.
Yeah, sorry, I've got another question for Nick. Sorry, Nick. It's only quite a simple question, but it's just when you're talking about lending to intermediaries that are lending to third sector organisations. So they can't be lending to SMEs or doing personal lending. Does that mean that if you have, say, a CDFI that was lending to all three, that they would then be excluded and you go to the fund, just so they could lend to the third sector bits that they're lending to? Thank you.
Were there any other questions before?
No, there aren't, Louis.
Okay.
Go on the chair here. Just watch it.
Oh, sorry.
You've got a question. Go on with it.
My question was not for Nick. It was you talked about the rebrand of CDFIs in the States, and it seems that even before you could rebrand into opportunity finance, you had what we call credit unions, social finance loan funds, social finance equity funds, CDFIs, as we call them, all under one common brand of CDFIs. And that seems an initial stage we'd first had to get to. My question was, perhaps, could you build that broader umbrella of a brand even before you rebranded, precisely because they're all beneficiaries of the same regulatory system like the CRA, and you have a similar investment relationship to them as well as their mission. So what's the bit before, perhaps the big rebrand, where we have to get a common narrative?
Okay, so let me just run through the first three questions. On the first question, look, I think the issue of the small business development bank is a very relevant one, actually. And I think it's particularly striking when Mark talks about, Mark is a lender, because the small business development bank is going to have to lend at and get its money back. It will be a leveraged organization. It will be giving away grants. It's going to have to lend in a genuine, sustainable way. Mark lends in a genuinely sustainable way in the United States. If we can do that there, you'd think there was a way that we could put together a pool of money to do that here. But again, I think the question on equity is a little different. Equity, unless these organizations meet the gold standard, and we've said there's a very small number either here or in the US to do that, then there is the equity tranche effectively is going to have to be a grant tranche. That will not come from the Small Business Development Bank. So you've got to somehow solve for that piece. And there are pools of funding available. The UK, potentially, we could do that. And I think your point about working together, we're following, Green Investment Bank, I think, is perhaps less relevant in this context. But I think we're following the development. We've met with the people who are responsible for the Small Business Development Bank, or the business bank. It's going to take a little bit of time before it really takes shape. But certainly there's a potential to do something there to address this issue of getting funding to places that we can't, because of our rules around us, that we can't do. On the CRA brand question, I welcome your comments. I agree, actually. I think if we're going to go down the road of promoting a CRA-like initiative here, and I think I know that it's something that various political parties are looking at. I do think we should change the brand. I don't know what the right brand is, but just copying something, a name from the US, is probably not the right way to do it. And as Mark said, it also allows, CRA is not by any means perfect, and it allows people, it allows people to push back on the basis of the issues of things that we know already are wrong with the CRA. But I think we should think of our own brand. On the question for CDFIs who are lending to both individuals, SMEs, and social organizations, could we lend to those? Our money has to find its way to social organizations. The problem we have is that there are you've already got a scale problem. Many of the CDFIs, the asset bases are not big enough. So when you start trying to split the money up even more, and create new pools, it starts getting even more problematic. So it's not impossible, but it makes a difficult issue or even more difficult.
So let me begin with responding to the question about sort of how did we get to the point that we were CDFIs, that we could even think about this in some way. So I thought about this earlier. So the term CDFI had not been used very much at all until suddenly we had a presidential candidate in 1992 who had this idea that he was going, Bill Clinton, who decided he was going to create a national network of community development banks and microlenders. That was his original campaign promise. And there were two things we thought about that when we brought people together. We brought everyone together. We saw there was an opportunity, but we also saw there was a risk. And the risk was, first of all, that the idea that we were going to build 100 community development banks was scary, because at the time I think we had 2 in the country, and it was the kind of idea that when government decides it's going to create de novo a whole bunch of something, it never works, ever. And although there were a small number of micro-lenders and microcredit organizations in the United States, the idea that we could create that many and that they could operate effectively didn't seem likely. And so we were able to get most of the community development banks, as in 1 of 2, and the credit unions and the loan funds and everybody together. And so we were defined by an opportunity and by a risk, which was that we wanted to create something that worked for everybody across the sector, but that didn't define it in a way that was going to do harm to us, which was our biggest concern. And so one of the things, and it's a term that gets used here a lot, one of the discussions I remember really well from that day in November in 1992 was that we had this discussion about the use of the term alternative lenders, and someone made the comment that in the markets where we work, they weren't alternative to anything else, really. They were the only lenders, and we needed a more positive, affirmative sort of name. And so that was, we just decided then and there to start being CDFIs. And quick side story to that was, we didn't know, we wrote up a paper that we gave to the Clinton transition. We had no idea if anything was going to come of it. And then 2 days before he was sworn in as president, Bill Clinton was on a very famous in our country MTV interview that he did with teenagers, and he started talking about CDFIs. And that was when we knew we were going to win from that term. But it held us together. Over time, it's been harder to hold that together because you get into identity politics, and people want to be their own kind of CDFI, and so people start talking about CDFI credit unions and CDFI loan funds, and it drives me crazy. But having said all that, once we had created that, once there was this notion of CDFI even within our own sort of world, it made it possible to think more broadly than that, because the term opportunity finance is intentionally meant to push the limits, to your point, Ed. I mean, we do that. We try and do that every chance we get. It was intentionally to say, maybe there's something beyond what we think of as a CDFI that we need to be thinking about, because it's going to be able to better serve the people in the communities that we need to serve than what we're doing now. So that was, I hope that's an answer to your question. One point I want to make about the CDFI fund and about CRA, if I can really quickly. CDFI fund, when it was created, was like no other federal program that existed at the time, and to my knowledge, ever existed, which is certainly in the anti-poverty world, which is that it was not an investment in a project, it was not an investment in an asset at the end of the day, it was an investment in an intermediary and its strategy. Because the thing that's most important about equity, wherever it is it gives you the flexibility and the ability to respond to changes in the market conditions. And CDFIs have to be able to do that if they're going to be successful. So it was unheard of. The only other federal program that exists that I know of at the US level is the TARP program that was created to bail out the banks, which does the same thing. But I tend to not associate myself with that in the United States, only when I come across while I talk about that. The second thing about CRA is absolutely, this is a long discussion, CRA as it was written is not what you want. There's no question it's not what you want. The best idea I got about it, and the term I talk about, came from Sir Ronald Cohen. I had breakfast with him in New York, and he talked about the work he had done in the US to get the pension laws changed to make it change so that it was explicitly an affirmative obligation of fiduciaries, of pension funds, to put a very small percentage of their money into these things in 1970 that were pretty small in the United States called venture funds. And it was the cause of the birth of the venture capital industry in the United States in 1970. And he said, what you need is an affirmative obligation for all companies that basically benefit from government support, which in the United States we now know is all companies after the recession. Seriously, I mean, it's an argument we were making for 20 years, and that's it. And so I need a better brand for it, but I think that notion of an affirmative obligation is at the heart of what needs to happen, and as it happens, it came from one of your champions, Sir Ronald. So.
Dan, do you want to add anything?
No.
Good. Thank you very much indeed. The tweets coming in, you'll like this one. John Waters. John says, better banking, that's the hashtag, exceptionally informative speakers with a consistently high standard of presentation. That's fabulous. Anybody want to tweet about the chair? Hashtag better banking. But I do want to thank the panel members very, very much indeed. We'll move on to the next session.
Thank you.